Investor is to maintain steady gains in the markets. A well-crafted trading strategy acts as a roadmap that keeps you aligned on the path toward your target goals, and it's essential for navigating the fierce competition within the financial markets. In this episode, we're introducing one of the high-level ICT trading strategies that offers the advantage and clarity required to stay ahead in the market, and this method will also outline how you approach trade entries and exits in a way that boosts gains while limiting risk exposure. Back traders, let's dive right in, but before we break down the strategy, you must understand the precise meaning and use of these concepts. We've already covered most of them in earlier episodes except for the ABC pattern. If you're new here and want full clarity on these key concepts, check out our past videos linked in the description, but we'll also give a quick recap of each one in this video. So let's begin with the ABC pattern. Now traders, what exactly is an ABC pattern? The ABC pattern is created by three major waves of price. In the bullish scenario, the ABC pattern contains a rally wave upward, then we have a bearish retracement to the downside, and finally we have the C wave to the upside. The C wave is a liquidity sweep that sweeps out the liquidity accumulated above the high. The B wave would contain a couple of bearish candles and doesn't have to be a significant downward wave, so this is the sort of pattern you should be looking for in a 15-minute time frame. According to the rules of our strategy, the key point is that a bearish ABC pattern is only valid when the C wave sweeps the liquidity above the highest point of the A wave with only one candle or wick, and a second candle or a wick should not form or close upper than the first candle's body or wick. We want to see price immediately change its direction to the opposite way and get back into the range below the high after sweeping liquidity. And also, a bullish ABC pattern is only valid when the C wave sweeps the liquidity below the lowest point of the A wave with only one candle or wick, and a second candle or a wick should not form or close lower than the first candle's body or wick. So let's proceed to the next concept: market structure shift. Picture a trending market forming a sequence of higher highs and higher lows. In this scenario, every high and low marks a market structure level, and we focus on the most recent higher high and higher low for confirmation. When the most recent higher high is broken to the upside, it indicates that price is likely to continue moving upward, and we define this as a break of structure. On the other hand, if the price drops below the high low, it signals a potential shift in the main trend, which we identify as a change of character. What's important here is that a break of structure is confirmed even if a wick pushes beyond the previous structure level, but for a change of character we require a full candle break and close below the previous market structure level. Picture a valid ABC pattern where the price grabs liquidity above the high through the C wave, followed by a single rejection candle, and then shifts direction to the downside. The next move is to wait for a clear change of character to form. So to observe that, we can zoom into a lower time frame such as the 1-minute chart, and we'd notice a formation like this. As stated earlier, we must wait for a change of character. Now, what defines a valid change of character within the ABC pattern? Under our strategy, a change of character becomes valid when price breaks the structure formed by the wave that triggered the liquidity sweep in the ABC setup. As you can see here in this scenario, price swept the liquidity by this tiny wave, so if price breaks and close a candle below this structure, then we have a valid change of character here. However, let's say price formed a structure like this on the lower time frame. In that situation, this change of character isn't valid because the broken structure doesn't originate from the wave that conducted the liquidity sweep and was formed afterwards. So for a change of character to be considered valid, price needs to break the structure that was established prior to the liquidity sweep movement. Now imagine price forms a structure like this on a lower time frame. In such a situation, the change of character is invalid since the broken structure doesn't relate to the wave that performed the liquidity sweep and was formed afterward. To confirm a valid change of character, price must break the structure created before the liquidity sweep movement. Now let's consider a different case. Assume price touches this high and reverses without taking out liquidity above it, then later continues upward, making a higher high that clears liquidity. Here we must wait for the structure of the initial move to be broken in order to validate the change of character. Keep in mind that we did not. So let's dive into the next topic: fair value gaps. What does a fair value gap mean and how do we spot it? Fair value gaps are areas formed due to imbalance in the market and typically appear in regions where trading activity is minimal and price moves in a single direction without much opposition. Fair value gaps serve as a powerful tool in price action strategies and indicate regions where significant order flow caused inefficiency in the market. FVGs highlight potential trade setups, particularly when aligned with order blocks, as these areas act as prime zones of interest. Fair value gaps often attract price later on to correct the imbalance since numerous pending orders exist there. We can also utilize them as target levels for trade entries. So let's break down how to recognize a fair value gap. Fair value gaps emerge within a 3-candle formation and typically show up as a dominant candle where the upper and lower wicks of the candles beside it do not fully intersect its body. This makes the fair value gap zone the space between those wicks aligned with the body of the central candle. In this example, during a downward price movement, a fair value gap or liquidity void appears due to a shortage of buy-side momentum that would have otherwise overlapped that segment of the decline. To accurately detect a fair value gap, it must involve an impulsive up or down candle, and the candles immediately before and after it. Other price action is irrelevant for gap identification. These liquidity windows are key and serve as valuable entry points in the market. Take this scenario where price shows downward intent aiming to clear liquidity levels overhead, making such regions ideal for a possible upward move followed by a stronger bearish continuation after testing. So traders, now that we've covered the foundational elements of our strategy, let's dive deeper into the specifics and examine the exact steps and guidelines we must adhere to. Our method is based on 4 essential steps to implement. Step 1 involves identifying a confirmed ABC pattern on the 15-minute chart. Step 2 requires switching to the 1-minute chart to search for a legitimate change of character. Step 3 calls for locating fair value gaps that are near the current market price. Step 4, we place our buy or sell positions at the designated entry zones on the 1-minute chart and wait for the market to trigger them. So let's begin by outlining how the entry setup works. As you notice, there's a confirmed change of character on the 1-minute chart. Now our next move is to identify fair value gaps close to where price currently is. Suppose we've found 3 fair value gaps nearby. Now the key question becomes which one offers the best trading setup. The important point here is that the uppermost fair value gap, located nearest to the liquidity sweep zone, takes precedence over the others. While it's possible to miss some setups by placing our order at the first gap, it offers a better reward to risk potential. So here we have a valid fair value gap. So in the next step we need to put our sell limit order at the lowest point of the fair value gap. Then we should set our take profit margin at the lowest point of the B wave, and also the stop loss must be set a couple of pip above the fair value gap's first candle, and already you can close half of your position when price reaches your 1 to 2 target. This way, even price rises and hits your stop loss, you are still at break even. In addition, you can manage your profits effectively, which means in a bearish setup, each time the market forms a lower high, you need to shift your stop loss slightly above the top of that lower high. We've already covered the core rules, essential concepts, and how to enter and exit trades. So now let's combine all of it and see how it works in actual trade examples. So we have the euro-dollar pair 15-minute time frame displayed on our chart. This represents the A wave followed by the B wave, and then we spot the C wave. Once the ABC formation is recognized, we need to confirm if this ABC setup meets our criteria. To do that, draw a reference line from the top of the A wave to the current price. As previously stated, a bullish ABC setup qualifies only if the C wave takes out the liquidity just below the A wave's lowest point using a single candle or wick, and the next candle or wick must not form or close beneath the first candle's body or wick. So as seen here, the price swept liquidity with this candle's wick and the next bullish candle formed above it and successfully closed over the line, confirming that our ABC formation is valid. There's a key rule to remember here. Once the first candle finishes, we switch to the 1-minute time frame and look for a valid change of character while simultaneously keeping a close watch on the second candle's body or wick from the 15-minute chart to make sure it does not close or appear below the first candle. If that happens, the setup becomes invalid and we skip the trade. So traders, this confirms a valid ABC setup has been spotted here. Now let's move into the current price zone. Next, we need to watch for the appearance of a shift in market structure or a change of character. So traders, as you notice, there's this structure right here that gets broken by price. Would this be considered a structure shift? The answer is no. This is because price tapped the line extended from the lowest point of the A wave, then reversed and formed this structure. But if you look a bit higher, you'll clearly notice another structure that was formed before the liquidity sweep to the downside. Now that we've identified a valid structure break or character shift, the next step is to locate the nearest lowest fair value gap around the current market level. As you can see, there's a fair value gap right here, so we position our entry at the upper boundary of this gap and place our stop loss just a few pips beneath the first candle of the gap zone and for our take profit target. Now we zoom back into the 15-minute time frame and set our take profit level at the highest point of the B wave. Just like we discussed earlier, you can see we've placed our buy limit order, and from here it's all about patience, waiting for the market to trigger our entry. As you can see, our buy order got triggered quickly. Now let's sit tight and watch how the market plays out from here. As you can see, price moved in our favor and eventually hit our take profit. The reward to risk ratio on this trade was nearly 1 to 6, a solid result. So let's review another trade example. So here we have the Euro-Pound 15-minute chart on screen. We can clearly observe the A wave and then we spot the B wave followed by the C wave currently unfolding right now. Next, we draw a horizontal line from the highest point of the A wave. Our goal is to confirm that the price breaks this level to the upside, sweeping the liquidity above the A wave with a single candle or wick. After the liquidity sweep, we want to see the price drop back below the line. As observed, the price did indeed sweep the liquidity with this wick and then closed below the line, confirming a valid ABC pattern. With that validation in place, we can now proceed to the next step. Now, we zoom into the 1-minute time frame and wait for a market structure shift, or change of character, to occur. As shown, this structure was formed before the liquidity sweep and belongs to the wave that executed the sweep. Price then breaks and closes below this key structure, confirming a valid market structure shift. With this confirmation, our next task is to locate the highest fair value gap above the level where the change of character occurred. This gap represents our primary zone of interest for a potential entry. Once identified, we highlight the fair value gap on the chart. We will place our sell order at the lowest point of the fair value gap, and set the stop loss a few pips above the first candle that forms the gap. For the take profit, we will proceed to the next step. Next, I'll zoom back into the 15-minute time frame and set the take profit at the lowest point of the B wave, which is approximately 0.882. Now that our sell limit order has been placed, we simply wait for the market to trigger the entry and move toward our target. Let's observe what happens next. As you can see, price moved upward and activated our sell order. However, there's a crucial rule you should always keep in mind. If the price reaches the highest point of the B wave in a bullish setup, or the lowest point of the B wave in a bearish setup, before triggering your buy or sell order, then the setup becomes invalid and you should cancel your pending orders immediately. In this case, price moved sharply to the downside after activating our order, confirming the validity of our setup and giving us a strong push toward our take profit level. And finally, our take profit was successfully hit around the 0.882 level. Before applying any trading strategy to your live account, it's essential to backtest it thoroughly, ideally over 100 trades and at least one full year of data. This will give you the confidence and data you need to trust the strategy. That's it, traders. We hope this video brought you value. If you found it helpful and want us to continue publishing high-quality content each week, don't forget to hit the subscribe button and turn on the notification bell so you never miss an update. Drop your thoughts in the comments. Let us know what you think and what topics you'd like us to cover next. We're always working hard to bring you valuable and insightful videos. Thanks for watching, and we'll see you in the next episode.